Good morning, everybody, and welcome to Hudaco's interim results presentation. My name is Stephen Connolly, and I am the chairman of the board. And I'm going to talk to one slide before I hand you over to the executive management. Okay, the first point I'd like to make is that there's a worldwide economic recovery from COVID. Shutdowns has been faster than expected. And the rolling out of infrastructure spending in first world countries is good for our commodity prices, good for South Africa. But supply chain constraints are now being felt in all Hudaco businesses. Stock is king and pricing power lies with suppliers. And Graham is going to talk extensively about that during his presentation. Unfortunately, we have a number of issues in South Africa. I can't touch on all of them, there are too many, but the ones that are immediately of concern to us are obviously the third wave, COVID-19, electricity supply, port delays, again, Graham's going to talk extensively about that during his presentation, and the rapid degradation of municipal infrastructure. Notwithstanding these concerns, Hudaco has been, in our opinion, exceptionally well managed through these very challenging times, and in particular the care that we have taken of our staff during the three COVID waves. And again, Graham will talk about that during his presentation. And in our opinion, the group has produced an excellent financial result in the first half of 2021. And lastly, we are cautiously optimistic about that momentum continuing into future earnings. So it's with pleasure now that I hand you over to Graham Dunford, the Group Chief Executive.
Thank you all for joining us. So on the agenda that I'd like to cover today is, first of all, I'd like to go through the results, a summary of our first half performance, the general business environment, the business model and operating segments. I'll just touch on that and some of the numbers coming out of those segments. The financial review, and then of course Clifford will take you through that financial review and the details of the finances. He'll hand back to me and I'll hopefully go through what we believe is the outlook for the rest of the year for Hudaco. So this slide I'm not going to waste any time on. I know for reporting we have to compare against last year, but last year was a disaster because of the COVID that we had through April and May last year. So these numbers are meaningless, and we're up 1,000%. I don't think means anything to anybody. What we think is more important is to maybe compare our results to how we fared in 2019, which was a normal year. And we're quite excited about these numbers, and we hope you are too. Our turnover over 2019 is 6.5% up to 3.4 billion. Our operating profit up 20.2% to 357 million. Our basic earnings per share is up, basic earnings, headline earnings up 30% to 6.86 rand, and our comparable earnings up 32% to 6.86 rand. This is a very good number. Our interim dividend has been increased thanks to those good earnings, and they're up to 26.3% or 2.40 rand. The cash generated from operations through this period was 393 million rand. And just for our shareholders, we returned 244 million rands to our shareholders in this last year, in this very difficult last year. So we hope that they are happy with that. And that came through the share repurchasing program that we put in place in the second half of last year, where we bought 82 million rands worth of shares in the second half of last year. And this year we've managed to pick up another 36 million rands worth of shares. And also what we have is the final dividend that was paid this year of 126 million for last year's performance. So a nice little 244 million given back to our shareholders. So let's just take you through the business environment. First of all, the momentum that I think when we spoke to you in January, we said that we believed that the momentum that we had with us towards the end of 2020 would carry on into the first half of this year. And it has carried on for us. We've been very fortunate. We've also had a bit of wind in our sails from the mining and manufacturing and agricultural sectors. I think with the commodity prices where they are, the mines are working flat out, manufacturing is supporting that. and of course the agricultural sectors are up. Unfortunately, we've had a decrease in our security sector. I'll talk a little bit about that later. And load shedding has been very disruptive. I think we all know about that. It's disruptive. So, for manufacturing and businesses to continue and perform when you've got these power failures is really bad. And that's affecting a lot of the manufacturing sides of business out there. There's serious challenges in our supply chain, and maybe just to touch on that a little bit. I think you've all read about that. I think we've managed our supply chain very well to have achieved what we've achieved. And I think a lot of that is because we've managed it well. It's having the right stock in the right place. We said it in January that we would like to increase our stock holding to cater for the disruptions in the supply chain. But, with the shortage of commodities around the world, the shortage of parts around the world, we've heard of all the different shortages that there are. And because of what Stephen said earlier on, this demand after COVID hit us last year, a lot of factories cut back, they shut down plants around the world, and they didn't expect the recovery to be as quick as it is. So now you've had this increased demand, and of course they couldn't keep up with it. So first of all, we've got those from our suppliers saying, well, it doesn't matter if you want 100, you can only have 50. So we have those supply constraints. Then it's a case of trying to get, once you've got been able to source parts, it's trying to get it on a container. And as we all know, containers are all in the wrong places right now. So that is a difficulty. And then, of course, trying to get it on a ship. Getting it on a ship that wants to stop. And I go on to the next point, is the delay in our ports. These ships don't want to stop at Durban port because it's useless. They are totally inefficient. So take away the COVID problems and all the rest. So all these other supply chain problems we're dealing with, it then gets to our inefficient ports, and there's even further delays. And this is a huge problem for us and for the country. As an importer, it really restricts our business, and our results could have been even better had these guys got their act together. But it's not just for us, it's for South Africa. We export a lot of stuff as well. And, things are sitting at the ports and not going out as quickly. So we urge the government to get their act together there. The rand strengthening has created pricing pressures, which we all know about. Hudaco as an importer, we prefer a steadily decreasing rand. That way we can put our prices up. You've seen what's happened since December till now. The rand has strengthened. So all that stock that we're sitting at higher prices, we kind of filtered through the system. And it's a case of managing that margin as best we can. So let's take you to our business model. A lot of you know this already, but I'll just touch on it briefly. Hudaco's main business is the importation and distribution of high-quality branded automotive, industrial, and electronical consumable products. The concept of value-added distribution is key and core to our business model, and our agency agreements generally restrict us to activities south of the equator. Our diversified portfolio of business limits our risk, but it also makes us very resilient. And you've seen from the results that we've managed to achieve over this last year. I think that just the diversification that we set out to do 7-8 years ago has really held us in good stead. And right now we're sitting in a very fortunate case that we have many businesses across many sectors. We also have many products in many of the industries that we serve. And that, of course, diversifies and reduces our risk. We have a lot of decentralized, focused management. So we have specialists in each of our businesses. And those guys, every day when they wake up, they concentrate on their products for their industries. And that, I think, is a very strong point of Hudaco. So there's quick decision-making, control, and accountability at the coalface where it's all happening. So let's just maybe take you through to our reporting segments. We've spoken a little bit about the reporting segments before, but effectively we have two reporting segments, the consumer-related product segment, and they import and distribute branded products, and those are driven by consumer spending, and they're generally sold to installers. We have 11 businesses in that segment, and those businesses supply automotive aftermarket products, power tools and fasteners, a lot of data networking equipment, and batteries and renewable energy products, security and communication equipment. There's details of each of these businesses on our website under Group Activities tab. Please go in and have a look at that. We're not going to go through each and every one of them here. The other segment, reporting segment, is our engineering consumable segment, and they import and distribute branded products. And these are generally sold for the repair and maintenance of machines. We have 18 businesses in this segment, and they supply bearings and belting products, diesel engines and spares, electrical power transmission products, filtration, hydraulics and pneumatics products, our specialized steel, and our thermoplastic pipes and fittings. Again, these are all under group activities. We don't normally show this slide. I think it was important for us to show you this slide here at half year because I'm sure you'd like to know where we're getting this wind in our sails and where we're getting some growth in our turnover. And here you can see that our wholesale, retail, and automotive is pretty flat. But here you see mining and manufacturing up nicely. Agriculture also sees up a little bit. And unfortunately, you see the security is down there from 8% of our business to 5%. So we've had our whole business growing and unfortunately security going backwards. So a bit disappointing for us there. And just to give you an idea of the operating profit in a pie graph there, in 2019, 65% of our profit came from consumer related, and this year 63%. And that's not because it's shrunk, it's because the whole pie's got a little bit bigger, and nice to see our engineering consumables growing from 35 to 37%. So talking to the detail now, if we have a look here, turnover for consumer-related products up to 1.8 billion, 3.3% up. Operating margin really nice at 13.8%, up from 11.9%. And we look at operating profit up 19% to 245 million rand. So let's have a look at what has actually, within these businesses, who has been moving and shaking. Our power tools and marine had an excellent H1. Really, really nice to see that. But this could have been even better. And it goes back to the supply chain problems. And maybe if I can just share with you an example of that. If we look at our marine, we're the Mercury motor distributor for South Africa. And we get allocated a certain amount of motors. We've tried to order more motors because we have a demand for it, and we just can't get it. So Mercury has said to us, no, hold on, you get allocated so many motors. So our motors for the rest of the year have been allocated. We know what we're going to get. And those are all allocated to by our customers and sold. So if we could get more, we could sell more. And I think the same goes with power tools. You know, we could get more tools than what is available right now. So supply chain constraints, but still a really nice result. Our fasteners business is now firing on all cylinders. You know, if we go back to 2 years ago, we had a lot of own goals that by moving this fastener business into Rutherford's, into a new warehouse, putting them on a new computer system, and we really just buggered it up. Unfortunately, we had long delivery times to our customers. We've now fixed that through 2020, and now it's really doing well. They have a little bit of maybe a little bit of help on their side on the safeguard duties. Now, I'm very much against the safeguard duties. The safeguard duties here for set screws is around 45 to 50%. It's ridiculous that it's there. I think it's just the government trying to get another tax out of business. You know, these things go into manufacturing. It's supposed to protect the local manufacturers. The local manufacturers cannot keep up with the demand. They don't have the wherewithal to do it, and Mittal can't supply the steel. So, you know, adding 45% to 50% onto the cost price of most of the fasteners that are sold in South Africa, it just increases our manufacturing costs, which makes us uncompetitive. So sorry to hop on about that, but I do feel strongly about that. Our automotive businesses had a really great result. Again, it's all now about having the right stock at the right price, and we seem to have that. Miro had a very good H1, but constrained again by supply. You've all heard about the semiconductor shortage around the world, and a lot of the products that go into Miro's technology do have semiconductors in. So a really nice result from them, but it could have been so much better had we had the stock. The disappointment came from our security business, as you've seen from the allocation of where our sales came from in the first 6 months. So they've had supply chain problems because of those semiconductors, but I think there's a little bit of own goals that we've scored there for ourselves last year. We spoke about it in January. We were hoping that it would be in a much stronger and better position than it is now, but it looks like we've got a bit of a road to go there. We move over to our engineering consumable side. Here, turnover up 10% to 1.6 billion. Operating margin at half year, we are very happy about this, 8.9%, up from 7.4%. And here you see the effect that it has, that we've always said that, our businesses are well suited now for any increase in turnover, and it just falls straight to the bottom line. Look at the operating profit. A turnover up of 10% and your operating profit goes up 32%. So we very happy with that result. And a lot of that came, as you've seen, from the increase in mining because of commodity prices, the manufacturing and the agricultural sectors. So thank you to them for helping us. So really a fantastic result from our steel businesses. Steel again, a little bit of help on their side. We've had about increase in steel prices from the mills around the world. Prices have gone up about 50%. Over this period, and that unfortunately gets passed on to our customers. So, and we found here it's all about having the right stock. So it's managing our stock and managing our margin, which our steel businesses have done very well in the first 6 months. Bearings International keeps going from strength to strength. They've had a really good first 6 months, so we're very happy with what's going on there. We've done a lot of branch consolidation, which has helped us. And again, here, stock and margin management has helped us to achieve this good result out of bearings. Our Beltings and Supply Services business and Brewtech, again, a very, very good first half from them. And we've increased our product range. We've added some rubber belting inside there that we arranged that we haven't had before. And we've got some nice contracts from that. And also the increase in business from our food and beverage and some of the contracts we picked up there. So a nice result from them. Diesel engines and filtration businesses also doing very, very well. Thank you, mining, for the increased the uptick in business there, and that's all flowed through into our diesel engine and filtration business. Consolidation of our electrical business that we spoke to last year, we're now seeing those benefits coming through in the first 6 months, and we see a lot more to come through in the second 6 months. Very happy with that result. And that leaves us our hydraulics consolidation. We haven't seen that all coming through yet, taking a little bit longer, and we hope to see that come through in the second 6 months of this year. So those are our reporting segments there. You add that all up, we have turnover up 6%, as I said at the beginning of this, to 3.4 billion. Operating margin nicely at half year, from 9.3 to 10.6 billion percent, sorry. And then operating profit, you see nicely up 20% to 360 million rand. A really nice result. I thought I'd just steal these slides from Clifford. He's going to talk a little bit to this. But what I like about these slides, it just shows you our first half performance here at 3.4 billion. And we kind of showed you what's happened over the last 7 years for Hudaco. And you see a nice steady increase in turnover over a period of time. So we hopefully, from a Hudaco point of view, that little hiccup that we had with COVID last year is behind us. But even with that, we produced a good result last year. And you can see also here that our turnover is always much better in the second half than the first half. So we are, as Stephen said, quietly optimistic about what's going to happen in the second half. And if we now again look at our operating margin, here we see how it has performed in the first half. The last time we had numbers around here was in 2015. So a really nice start to the year. So I'm going to hand over to Clifford Amels. He's going to take us through the financial review and the detail around that. So over to Clifford.
Graham has shown you the build-up of these numbers, but before I go further, let me just explain the format of my slides here. 2020 we've put on the right-hand side and with grey blocks behind it, and that's because we don't really, as Graham explained, we don't really see it as particularly relevant. There are one or two numbers that I will refer to, but in the main I will ignore 2020 and deal with just 2021 and 2019. So these numbers presented in a different format, but you've seen them already. So turnover at 3.4 billion, 6.5% up. Our gross profit, 1.25 billion. That's 9% up on the 1144 of 2019. And that clearly is going to reflect in the gross profit percentages. Operating expenses, 890 million, that's 5.1% up over 2 years. So we believe that's been tightly controlled, and we're very comfortable with that level. And then operating profit, 357 million rand, which is 20.2% up on 297 million rand from previously. So if we look at the margins, with turnover at 100%, our gross profit 36.9%, that's 0.9% of turnover up on 2019. We're delighted with that. The operating expenses, 26.3, so that is down on the 26.7. So those both give us a boost, and our operating profit overall is 10.6% margin against 9.3. Going back to the numbers in rands, so that operating profit, 357 million rand, and we have net interest on funding of 34 million. Now I just need to clarify here, that interest on funding in 2021 and 2020 includes the imputed interest on leases. In 2019, it doesn't. So that's a distortion that was complex to sort out here, but what we've done instead is we've put a couple of slides right at the back of the presentation, but only in the version that's on the website. I'm not going to talk to them now. And also in the cash flow statement, which I will deal with, we show the separation. But of that 34 million, 19 million is real interest and 15 million is just out of the IFRS 16 adjustment. Then, yes, in 2020, one of the rare occasions I'll mention it is we had the impairment of goodwill and intangibles driven by COVID and associated lockdown. The rest of the adjustments here to profit before tax, well, there's nothing in 2021 and a small fair value adjustment in 2019. So our profit before tax at 323 million, 35% up. Our tax, 90 million, is a tax rate of 27.9, so as near as damn it to the standard tax rate of 28%. Profit after tax, 233 million, is 32% up on 176. There's no income from the joint venture, and that's because we now control the joint venture as of the end of 2020, so it's fully consolidated. Profit for the period then still 233 million. The minority shareholders are entitled to 23 million of that. Now that's the main minority shareholders are the BE trusts in Hudaco Trading, and chunk of that which owns almost all our businesses, and then our German partners, Deutz in the Deutz diesel power business. So attributable earnings, 210 million, 24.4% up on 169. So then moving on to headline and then comparable earnings. There are no adjustments between basic headline and comparable earnings in the first half of 2021. In 2019, headline and basic were the same, and there was a small fair value adjustment which comes with an associated minority interest. So that was at 165, at 27.6% up now on comparable earnings. Just looking at the comparable earnings in millions of rands, half by half. So the first half is the blue block, the second half the grey block, and we have 210 million rands worth of comparable earnings, and that is a record for the first half for Hudaco. We've never had as much as 210 million comparable earnings before, so we are delighted with that. You can see how significantly up on the last few years it is, and as most of you will know, our second half normally delivers stronger earnings than the first half because there are 6 clear trading months. Whereas in the first half, we have 3 holiday months in December, January, and April. And November and December are our busiest months. So on an earnings per share basis, 686 cents per share for each of the 3 measures. In 2019, there was comparable slightly lower, the other 2 the same. So we are 29 and 32% up on those. Dividends, our interim dividends, 240 cents. We've moved it up 26.3% on 2019's 190 cents. There was no interim dividend in 2020. It was far too uncertain and we hadn't really made enough profit. And then in 2020, we had a strong second half. So we paid 410 cents, which was the same as the 410 cents we paid in 2019. We were delighted to match it. And we hope to have good news for you at the end of the year, but time will tell. Our dividend cover, remember our policy is to be a little bit more than 2 times covered on a full annual basis. But the first half dividend is It's the lower of the two, and therefore we're 2.86 times covered now, whereas in 2019 we were 2.74 times covered. Comfortable levels. Moving on to what I still call the balance sheet. Working capital 1.9 billion is a little bit lower than we would like it to be, and you can see it is down from May 2020 and 2019. And the reason it's down is primarily inventory, and we'll come to that in more detail, and Graham has already explained to you about the issues in the supply chain. Our property, plant and equipment at a little bit over $250 million. Right of use assets, that's IFRS 16 coming into the balance sheet. Our goodwill and intangibles at 1,195,000,000. It has moved up a little bit because we have bought some software. Computer software is now in there. Nothing special about that software. It's just our normal expenditure on that sort of thing. The bottom half of the balance sheet here, equity 2.7 billion. It's up to that. Very significant is our bank borrowings are down to 594 million, and that is approximately half of where it was at May 2019 and May 2020. So well down, and that's because we've been very cash generative. The lease liability is IFRS 16 again, and there's nothing much else to talk about there except perhaps for the fact that we don't owe anything to vendors or businesses on earnouts. Looking at more detail on the working capital, firstly, overall, the blue block, the darker blue block is the inventory, and you can see that has come down significantly from the end of 2020. The debtors and the creditors, receivables and payables, more or less contra each other, and so the black line shows the overall working capital number, and you can see the drop. I said it's coming primarily out of inventory, so there it is. We are at 3.1 months of sales in stock at the moment. At this time of year, we normally stock up for the busier second half. So a more normal and comfortable level would be 3.3, 3.4 times covered. Because of the supply chain issues, we would actually like to be a little bit higher than that, so maybe 3.5 times covered or even 3.6. But Graham explained the difficulties, and we're not there. So our inventory is at a level that's not too uncomfortable, but we would prefer more. The cash flow, now what I've done here for 2019 is adjusted a couple of the numbers for IFRS 16 so that you've got comparable numbers next to each other. So cash from trading at 458 compared to an adjusted 408. We've put 65 million rand into working capital. So cash from operations, 393 million. Finance costs paid. Now these are the real finance costs. That's 19 million rand against 55 million in 2019. Tax paid of 62 million, giving us cash generated after tax of 312. We repurchased shares in these 6 months to the extent of 36 million rand. Our lease payments were 62 million. So that's the good old-fashioned what the lease agreement says and the cash that flows out the business, 62 million rand. We paid 135 million rands worth of dividends. That was the final dividend from 2020, as well as some dividends, smallish numbers, but through to minority shareholders. And then we invested in new businesses, software, property, plant and equipment, 23 million. In fact, there was no new businesses in 2021. That was in the prior periods that we had earn-out payments. So this is just PPE and software, 23 million this time. Net movement, a net cash gain of 52 million rand. We started the year with borrowings of 644 million, and so we are down to 594 million rand as we close the half year. Delighted with that. So on the financial side, just a couple of points to wrap this aspect up. So our margins are up. Our expenses have been tightly managed over the 2 years. Our inventory is a little bit lower than we would like them to be, but we do believe that we have adequate inventory to meet the demand that we're going to have in the second half of the year and deliver what we need to. And then our cash generation, as you've just seen, has been very strong. Our borrowings are well down. And just a reminder that when it comes to investing money, we consider all our capital allocation options each time. So whether it's making an acquisition, paying down debt, buying back shares, or paying dividends, we look at the options and make what we think is the best decision at that particular point. And with that, I'll hand back to Graham to take you through his outlook.
Thank you, Clifford. I'll make sure I'm in the right frame here. Okay. So, looking forward to H2 of 2021. Obviously, as usual, very difficult for us to predict what will really happen in the second half. I think an important thing for me to maybe share with you is those that were with us this time last year when we did our results presentation, and the sacrifices that our staff made and the companies made, and where we were at. It was a very, very difficult time, and we had no idea what the sort of next 18 months and how it would unfold. And then to be sort of a year later and be in this position to produce these really, I think, good results over 2019 is, we just have to thank our staff. It's really the managing of the supply chain, which I think has really been good for us. So yeah, it's just to go back and think of where we were this time last year to where we are now. We're very grateful. So the biggest threat we have, we think, to the H2 performance is this third wave of this COVID. And please, dear God, we don't get locked down again. Obviously, we need to keep everybody safe, but we also need to keep our businesses running. So that's a big risk and worry for us. We believe the synergies and benefits from the consolidations that we've spoken about in my presentation, or that we've seen on the electrical side starting to come through. Those are going to now accelerate in the second half. Hydraulic side, we see that coming through, and hopefully we're going to get a better performance out of our security business, and now in the second half. And despite these supply chain issues, we've spoken a lot about them, and they've been very disruptive. But for us, because of our inventory levels, I think we are very well managed, and this decentralized. Each of our businesses, the supply chain is managed by each of those people, and we think managed well. Maybe not so well in our security business, but in our other businesses. And that's what's really helped us produce this result, is having the stock. And we believe that the way we're managing it, the wind that we have in our sails, the first half performance, we believe that momentum will carry us through for the second half. And as always, we generate really good cash. We've generated good cash in the first half, and we expect to generate more cash in the second half. Our acquisition activity has increased. Nice to see again. We went through a very quiet period, rightly so. Last year after COVID, we decided to just hang in there and wait and see. I think we're back into a very strong position now, and it's back on the table. So I think that's just about all from the presentation. I just want to thank you all, and I'm sorry about the signal problems that we've had. I hope you've got it all. We will have this recording, or a new recording without the problems, on our website in the next couple of days. So thank you very much.